So I should say that obviously Iain is a investment director in the UK and European equities team at Aberdeen. He's been doing that since 2015. Iain is lead manager of Shires Income, deputy manager of Murray Income, and of Aberdeen Equity Income Trust as well. Iain, can you just give us a quick sort of elevator pitch, if you like, just spend a few minutes talking sort of through Shires, which we're going to sort of discuss today, just for those that perhaps need a bit of a refresh or perhaps aren't or less familiar with the fund.
Sure thing. So Shires is a UK equity income trust, basically. And the main goal we have is to deliver a high level of income, which is sustainable and resilient through cycles. So at the moment, the trust provides about a 6% dividend yield, and we've been growing that modestly over time, and there's over a year's cover of dividend and revenue reserves. So we should have a high yield, very competitive with the market, competitive with cash and bond returns, and that should be very defensive. But we also aim to maintain that potential for capital growth over the longer term. And we have quite a diversified equity portfolio with plenty of growth and SMID cap exposure in there to provide the growth. I think what differentiates us from most of the UK equity income trusts out there is primarily a fairly material holding in preference shares. So about 20 to 25% of the portfolio is in preference shares, and they give us a very high stable yield. So all the preference shares we hold yield above 8% at the moment. They are perpetual and they sit above equity in the capital stack. So you have a big block of the assets that do the heavy lifting on yield and allow us to have a much more diversified equity portfolio. Then we also hold some overseas shares for diversification, and we have some small option writing program as well, just to enhance income. And the overall aim is that we have that high yield. It's very defensive, but over time we have plenty of scope for good capital growth out of the portfolio as well.
Excellent. Just sort of on the preference shares, is that something that you manage yourself, or is there a sort of dedicated team in Aberdeen that helps you with that?
So we manage it ourselves. You're looking at about 7 or 8 positions, so it's not a huge portfolio, and the turnover on them, understandably, is very, very low. So we rarely buy and sell them, partly because they don't get issued very often anymore. It's quite a narrow market, and if you have them, you tend to want to just hold on to them. So it's an easy bit of the portfolio for us to manage. The preference shares are issued primarily by companies we cover as part of our equity coverage. Yeah. In any case. So it's very straightforward.
So would you tend to see, say, the sort of equity and the prefs in your portfolio? I'm guessing if you like the equity, you probably like the prefs as well. Is it sort of further up in the capital structure?
I would say it's not quite that simple. They tend to move quite differently. The preference shares obviously move much more closely with fixed income instruments. Yeah. And there are not that many companies that have issued or still issue preference shares. So the overlap is very limited. Standard Chartered is the only one in the portfolio where we have both preference shares.
How much of the portfolio is in overseas?
We have a 10% limit as a percentage of the total portfolio, and we tend to be around that level.
And is that a sort of similar situation? You manage that yourself, but at the sort of same time, I'm guessing there's plenty of resource in Aberdeen that you can fall back on. Is that a sort of fair description?
Exactly right. Yeah, we manage it ourselves. We'll meet the companies we hold there, just as we would the UK names, but we do have access to a big European team, plenty of other European fund managers out there and European income managers who we can chat to. We can steal their best ideas, and that certainly makes it easier.
Okay, that sort of makes a lot of sense. Are there, so obviously the whole Aberdeen ethos tends to be sort of very, bottom up, company specific, sort of etc. Are there sort of any investment themes though that you could say sort of run through this at all?
So I think thinking about the equity positions, what we look for is, obviously a good level of income, and that doesn't have to be a high headline dividend yield today. What we really look at is a combination of dividend yield and dividend growth over time, because that is generally what works in income investing. All our back testing would prove that, and it keeps us out of the kind of high yield dividend traps where
Yeah.
you can make a nice income year one, year two, but over time the only way is down. And the other thing we focus on is the quality of the businesses we invest in. So that's a bit more of a nebulous concept, but when we talk about quality, what we're looking for is good businesses, good market positions, high barriers to entry, strong balance sheets, and management teams that we rate and trust. And those things come together to give better growth prospects and I think a higher degree of resilience through cycle for the cash flows and therefore the income component from those stocks. So that kind of combination of income and quality is what we're looking for in the positions.
Yeah. And what sort of yields are you getting on the sort of underlying equity positions? And is it sort of fair comment that presumably with the yield that you're getting off of the prefs, that allows you to sort of do as you've described and go for stuff that's perhaps a little bit less yieldy today, but will give you the growth and presumably the sort of valuation uplift over the longer term?
Absolutely right. Yeah. I mean, there's a chart we have in the marketing deck where we kind of split the portfolio down into yield buckets. 1 to 2, 2 to 3%, etc. yields. And the preference shares sit in the highest yield bucket, but once you take them out, actually the portfolio is pretty much evenly spread across those different yield buckets. And there are things in there which are nice, high single digit or even double digit yields where we've got high confidence that they'll be maintained and grow. But there's plenty of things down in the market or below market level yield where we think we'll get good capital growth or income growth out of those. And we try not to limit individual stock positions based on something like just the headline dividend yield. We'll try and keep the eye on the horizon, look at what the overall portfolio yield is, make sure we're delivering overall income growth to the end client, but we can do that in quite a nice diversified way within the portfolio.
Yeah. Okay. I mean, we should mention quality a moment ago. When I sort of think of, the way Aberdeen portfolios are described, that's a sort of word that sort of comes up sort of regularly, and it sort of tends to suggest that perhaps in more difficult times that they are sort of more resilient, or you expect them to sort of be more resilient. I mean, I sort of wonder whether because of that, perhaps the sort of portfolio is perhaps sort of a bit more expensive on average. Is that sort of fair comment? Is there anything that you can point to argue that one way or the other?
Gosh, that's a good question, actually. I haven't looked at our headline PE to kind of bring it to one number. But if we screen on style across the portfolio, then we are ahead of the market on dividend yield, unsurprisingly. And we're ahead of the market on growth. And we are roughly neutral on value. So it is not an expensive portfolio. And I think maybe the competing forces of looking for capital growth and also yield today means you kind of balance out that that driver. It's not too expensive a portfolio, which I think is probably a good thing right now. I do think, if we wound back 2 years, then at a period where growth and quality were kind of synonymous with each other, and after a long period of falling bond yields, you had both a high growth premium and a high quality premium in the market, then we quite aggressively pushed into more value positions at that point in time. So we sold a lot of the more expensive things there, and we've been kind of buying back some more expensive bits of the market at cheaper prices over the last year or so.
Okay, that makes a lot of sense. Just, I guess, to follow on from that fleet or theme slightly, if you say sort of look at the portfolio, you're saying that there's a sort of growth bias. There are sort of slight growth bias there, but obviously, how these things offset. I mean, what might you be typically expecting from sort of across the portfolio in terms of, say, earnings growth and dividend growth, and would your sort of portfolios tend to screen perhaps a bit more growth in terms of those than the market or the benchmark?
In terms of earnings growth, I think possibly slightly ahead, but we are not trying to compete with a US tech fund or a NASDAQ tracker with this product. The focus is on generating resilient income, not on delivering growth. And in all honesty, we're getting a bit of a growth boost at the moment because some of the traditional income sectors like banks and energy are seeing earnings growth, and they're kind of screening as more growthy than they actually are over the long term. So I wouldn't want to overstate the growth. Then equally, we're getting some really nice high growth companies into the portfolio as well to fill that gap. In terms of income growth, I think if we do kind of mid-single digit percentage income growth year on year, I think that's good. I think we can do a bit better than that. The market tends to underestimate the potential for dividend growth over time pretty consistently. But at the moment, we're seeing that dynamic in the UK market where post-pandemic and a lot of dividend cuts, companies are shifting from paying a high dividend per share to doing more share buybacks because that is more and more counter-cyclical. It's more flexible than just having a fixed dividend per share that you might then need to cut. And that maybe limits the dividend growth a little bit, but we tend to think about total distribution yield, i.e. dividends plus buybacks, is what we're getting out of the companies. And I think that the outlook for that is pretty good. UK companies are not over levered by any means. Payout ratios are quite low, so yields can continue to grow, I think.
Okay, that's super. Just looking at this sort of slide here, it does say obviously you've got the position Aberdeen Smaller Companies Income Trust, obviously provides access to the higher growth. How much of the portfolio is that? Then can you just perhaps talk a little bit about that?
Yeah,
I'm guessing presumably there's no double counting of fees.
There's no double counting of fees. Yeah, I think that's a point you've always got to make because that would be a bit cheeky. So that has historically been a reasonably material position in the portfolio. It's the largest single equity holding, and it's about 10% roughly of the portfolio. It has been a very good long-term performer for us, but it's struggled a bit in the last few years as a strategy which is very focused on momentum and growth has not been that great, and as liquidity has come out of SMID caps in the UK, as we know. I think it's well known that we're going through the process now of a proposed merger between the two funds, so we will hopefully take Ascot into Shires, dependent on shareholder votes. And I think that will be a good thing for Shires because we will avoid the illiquidity of that position. We will avoid the impact we can have on performance as that discount widens or narrows over time. And it will give us an ability to have a exposure to small caps that we can manage more closely ourselves. And I think it simplifies the portfolio and makes things a bit clearer. It will also grow the asset base, and I think there's the nice simple benefit there of just spreading costs over a larger asset base, which is beneficial for end shareholders. Yeah, no,
that actually sounds like it makes a lot of sense. Perhaps it hasn't been sort of thought about yet, but will that effectively remain as a separate portfolio within Shires? And sort of how will it be managed? Has anybody had come to a view about that yet? Or
so what we've said is that the overall portfolio will be managed as Shires is today. And what we want to make sure we do is keep that small and mid-cap exposure that we've got, because it's a great source of growth. It's a great source of really underappreciated companies in the UK at the moment because there's not a lot of coverage. And the Aberdeen small cap team is really good. So we've got some really good experience and expertise there that we can take advantage of. I think the difference with doing that directly rather than via the Smaller Companies Trust is that we won't want to run too many positions. If we had 50 equity positions, they had 50 equity positions, there might be an overlap of 15 to 20, but we wouldn't want the total number of equity positions getting up to 80 or so. We'd want to rein that in and concentrate the small cap exposure in the best names that best fit our process within the portfolio. So I think that's the change, and that gives us a little bit more control for myself as a manager of Shires, and it allows us, I think, to just concentrate in a little bit on the names we like most within the small mid-cap space.
Okay, excellent. So another thing that you do is obviously there's the option writing program that obviously enhances income. I'm presuming that's sort of things like covered calls, etc., etc. Perhaps could you just talk us sort of a bit through that, please?
Yeah, I think the option writing program is always something that sounds complex, but in reality is very simple for us. And I wouldn't want to overstate the importance of in terms of income. It's a nice tool to have in the toolbox, I would say. So if I was to give an example, let's say we have a big position in AstraZeneca, and AstraZeneca's gone up pretty consistently over the past 5 years. It's been a great performer, and we want to think about trimming the position. We could write a call at a price above where the market trades today, and we will earn the option writing premium on it. And if the shares go up above that price, then the option will execute, and we will effectively sell some Astra at that price. If the option executes, it will be below the market price on that day, but that's fine because we would have sold it below that price in any case. And if the price goes down, nothing happens. We still earn the option writing premium, which is not money for nothing, so we're taking some risk in the option writing, but it's as long as we are writing options that are consistent with how we would deal in the equity portfolio anyway, we're not taking any additional risk there. So it's a nice way to add a little bit of income at the margins.
Yeah, and presumably these are quite short-dated options, are they?
Yeah, we usually look about 2 to 3 months out in the future. If you go beyond that, obviously the risks change, and equally, if you go into like maybe just 1 month, then you tend to find the premiums you're earning are not as attractive. So that's the kind of balance we have.
Yeah. No, that makes a sort of lot of sense. I suppose, is it worth perhaps talking about a couple of stocks that sort of perhaps would give us a bit of a flavour for the kind of thing that you do?
Yeah, sure thing. Why don't I talk about a couple of things we've bought recently? And there's a slide in the deck, if people can see it on the screen, which I think is slide 10 or so, which has a little Venn diagram of all the things we've kind of added in the last year. So if you can pull that one up.
No, I'm going in the wrong direction. So
here we go. We'll get there. That one.
This one?
I can just see the appendices slide, but I think you'll get there. I think it's the one before that one. That one. Up.
This one? Sorry.
So it should say portfolio changes, and it should have kind of a diagram with 3 circles on. I can see it now. So hopefully
perfect. Sorry about
that. So I love talking about stocks, so I could pick any of these and talk about them quite happily. But if I think about the most recent purchases we've done that I think are, at different ends of the spectrum in terms of what we're trying to deliver, then I'd go for maybe IP Group and NL, because I think they show you interesting things about what's happening in markets and how we have a kind of barbell approach on the positions. NL is the easier one, I think, to talk about. We added it fairly recently, and the obvious attraction is it's defensive. I think equity markets look quite fully valued at the moment, and I'd like to have some defensive exposure. It's got a just over 7% dividend yield, which is attractive, and because it's a regulated utility, that dividend yield is very, very safe. We can pretty much rely on it. That's so far so good for utilities and doesn't really necessarily get you out of bed in the morning. But I think what is interesting for long-term investors is the undebatable need for Europe and the UK to invest significant amount in clean energy infrastructure and storage over the next 10 to 20 years. And a company like NL, which has a meaningful position in renewable capacity and in distribution and storage within Italy, a bit of Spain, a bit of US, it almost inevitably has to grow its capital base and earn a competitive return if you have a long-term time horizon. And that supports dividend growth over that time, and will be paid pretty well to wait, and the risk is relatively low in it. So that it's a nice way to get, I think, if you've got a long-term time horizon, that kind of utility area exposed to clean energy growth is really attractive. So SSE is one we've had for a long time as the UK name that's most exposed to that, and it's done very well. We still really like it. That's not going to do anything particularly quickly, and hopefully the error bars on the outcomes are not massively high. But I think if you come back in 5 years, it'll be worth more, and if you come back in 10 years, it'll be worth more again. IP Group has much higher error bars on the outcomes. There's no doubt about it. So this is a company which invests in early stage technology companies, and it has a very strong relationship with UK academic institutions. So it takes a lot of projects out of them and helps commercialize them and make them profitable. And it's been involved in the development of a number of successful companies like Ceres Power and Oxford Nanopore, for example. And it still has a big holding in Oxford Nanopore now.
Yeah.
It has, beyond that, a really nice diversified portfolio of very high impact early stage tech companies spread across biotech, high tech in a kind of IT way, and energy and clean energy. So things like fusion power and hydrogen generation. And within the portfolio, it has a number of things which are really meaningful, maybe not the highest chance of success, but high reward if they are successful. And a diversified portfolio of those things can deliver very good returns. In an income fund, it gives us a nice way to get access to really high growth opportunities. And there's a number of really meaningful potential catalysts over the next 12 to 18 months. What made it really interesting for us was that we've kind of observed the boom and the bust of private capital valuations over the past few years from one step removed, and kind of enjoyed the realization that actually interest rates should not be 0% and valuations should reflect that. And that's caused, I think, a lot of valuation opportunities to open up in that market. An IP Group, it trades at about a 50% discount to its published NAV. And we've done a lot of work to get comfortable with how prudent that asset valuation is. If you take out the listed stakes, such as Oxford Nanopore, then the remainder of the portfolio trades at an 80% discount to the current published asset valuation. And that gives you a pretty big margin of error on things not working out for the company. You're already saying 1 in 5 things is going to work. And then they're only going to maybe work at the low level of potential. So we see pretty material upside potential in the business. I think the discount can close, and I think it's a really nice way for a UK income fund or any UK fund to have really exciting growth exposure within it. And it pays about a 1.5% dividend yield, which is not massive, but it's helpful, right? It's a good way to get exposure to that sector.
Excellent. Okay.